The second really great way to destroy your net worth is to use the market as a source of information as to what you think a business is worth. So, you know, the average investor's experience in the stock market is rather poor, right? I think we all know that. There's a tendency to, you know, buy high and sell low, and it's sort of natural, right? I guess, you know, Stanford's got their first football game coming up next Friday, right? And so if you go to campus, you know, you want to find your way to the stadium. The best way to do that is to sort of follow the crowd. That's a natural thing, but in the market, you know, when you're in agreement with everybody, you know, that can be a really dangerous thing, right? So I would say the market. Okay, so let me back up a bit. So if you invest in equity security, if you buy a stock, right? I would encourage you to think of that as if you're buying a proportional share in the assets of the company, right? And, you know, you should value that business, right? And hopefully, you know, you're doing it in a field that you know something about so that you can make an educated guess as to what that business is worth. So if you and I got together and bought a dry cleaning business, right? And someone walked in one day and said, I'll give you $5 for this place, right? You'd tell them to take a walk, but it certainly wouldn't freak you out, right? That your dry cleaning business is only worth $5, right? The same thing is true about the equity markets, right? You can't let a market quote turn from an asset that you can utilize when it's in your favor to a liability that's going to, you know, take you out of the market. And so that comes down to a concept of what I would think of as true north, right? So if you can't use the market to tell you what something's worth, you can only use the market as the price at which you have the option of transacting, right? Then you need to be able to value the business yourself, right? And here you have this wonderful quote that basically says, you know, being right is not about being in the crowd. Being right is not about, you know, having well-respected people agree with you. Being right is about putting your facts together, right, and then reasoning them through, right, in a sound and logical manner. And if you do that consistently over time, right, that's what's going to give you success. So I just think, again, to Brexit, where, you know, all these folks, they see the television, you know, oh my God, the world's going to come to an end. I mean, forests were felled to create the paper on which Wall Street wrote reports about, you know, the implications of Brexit, right? Literally, I can't imagine. I mean, and they all end with the same thing, which is basically, I think it's going to be bad, but I really have no idea, right? That's the conclusion. So, you know, folks that get scared because of that, and I think they get, you know, it all gets rather accentuated by, you know, the way it's portrayed in the media. And, you know, ultimately for value investors, it's about finding great companies, harnessing the power of compound interest. You know, Fidelity had this great story that I just love. The best performing Fidelity accounts, according to a big study that they did, were of the individuals who forgot that they had an account, right? So, you know, trading is not your friend. Listening to the market is not your friend. You know, try and figure out what you think a business is worth, right? And worry about your view of its intrinsic value and how it's changing over time, and put the market aside, right? One more point I'll make on this that I really enjoy from Buffett's commentary is that, you know, risk is oftentimes a quantifiable notion to a lot of people. And Buffett thought very differently from almost the very beginning, right? Risk is not beta, right? Beta is the amount by which a stock squiggles, right, over a certain period of time, right? To Buffett, that's not risk. Risk is not knowing what you're doing, right? So maybe you have the wrong facts. Maybe you've thought them through in a way that was internally unsound. Maybe something that you didn't consider came into the picture and your hypothesis was wrong, right? Being wrong is risk. Not knowing what you don't know is risk. Okay. Squiggles don't matter when you're in Buffett's shoes, which is thinking about companies divorced of their stock price, willing to cheer for them to go lower because you don't really care, you don't have to sell, and you're more than happy to buy more. Buffett found himself in these positions where he would buy a little bit and the stock would go down. And his intrinsic value estimate didn't change, so he'd buy a little more. And it would go down. And it would do so for years, right? And he didn't need the market to tell him he was right. It was his own reasoning that led him to that conclusion. The third thing that I think is a really good way to fail is to play somebody else's game. And there's going to be times where value investors feel like they are out of sync with the market. And it's really hard, I think, to stick to your philosophy and your principles when you're in the sort of speculative froth of a bull market, right? So we saw this at the end of the partnership era, which was as we approached 1970, you were in what they called the go-go phase of the market. It was the conglomerate era.